Hi there. Wanted to talk a little bit about health savings accounts, and I think maybe we'll start with just a general overview of what they are and why you should be considering or looking at them. Okay, so a savings account, and if you've ever had a flexible spending account, you can kind of consider them somewhat similar, but with health saving account giving you a lot more capability. So we're going to defer the conversation about how you got the health savings account, whether or not you have it because you work for a company that offers it, or because and offers it with an association with a health and plan, or if you're an individual who is going to the marketplace and looking for a plan that way. Both of those have a completely different benefit case, and I want to kind of separate those and bring that to you in a separate conversation. But essentially, a health savings account allows you to take some level of your income, and we'll talk about amounts, and put it into a tax deferred account. So if you are a independent contractor and you put money in a health savings account, that income is now sheltered from taxes. It is put away for future health expenses, and we'll talk a little bit about what those expenses are and how you can kind of get those. And it does not expire at the end of the year. It stays with you. It behaves very similar to an IRA, in that there are certain plans where you can actually invest that money and let it grow. But certainly you can use it for current health expenses and future health expenses, right? So I think it's important from that perspective. You know, uh, I think we talked about that it isn't taxed. We'll talk a little bit about some of the ways you can spend that money. This is a list: acupuncture, ambulance costs, doctor visits, hearing aids, prescription drugs, psychological therapy, long-term care. But I think the one to be most interested in is, for me, is the deductions. So when you have an insurance plan, you have a deductible, right? And so being able to use this plan allows you to cover your deductible with tax-free funds, right? We'll get a little bit more into the case of the person who has a marketplace plan and sort of what those strategies are in a separate video, and that'll be labeled Marketplace HSA, and we're going to get to that very shortly. Okay. So you pay no federal income tax on the money earned that's put in an HSA. That is a very important piece. There is no expiration on those funds. So not like an FSA where I put money away at the beginning of the year, and if I don't use it, I lose it. You're not going to have any of that, right? You can use it. The money can be used by you or any member of your family, which includes your spouse and dependents. We'll have a separate video on how we handle domestic partnerships or other types of arrangements that are not spousal. And so essentially in 2024 and 2025, you have a certain amount. If you're single, you can put away. If you're in a family coverage scenario, which purely means you have a spouse or you have dependents, right? And so you can see the amounts are going up. And then you also have a catch up if you're greater than 55, right? So there are some implications if you take this money out before 65 for Medicare related expenses. Again, we'll talk separately about Medicare in the future, but wanted to kind of just give people a pretty quick overview of the process and what it means. So there are a number of companies that deal with the administration of health savings accounts. We'll talk a little bit more about that. One that you may have heard of is Health Equity. It's one that I do work with quite a bit, and but this is, I want to make sure we're clear, and I will have a separate tax conversation with folks. But when you put money in, you pay no taxes on the money you put in. So if you earn $100,000 a year and you put in this year because you're over 55, 8550 plus 1,000, 9,550, then what you just did was your reportable income for this year is no longer 100,000. Your reportable income for this year is going to be 90,450, right? And so you can do the math on what the tax savings are on that. But if I'm not incorrect, if you're making $100,000 a year, that's about 22%. So you saved well over $2,000 in taxes just by putting your money aside for future medical expenses, right? Um, and when you take that money out, you don't pay any taxes either, right? So when you remove that money and you pay for the expense, there's no taxes paid. So you've saved doubly. And if you're in an employer HSA, the money that your employer matches as well is not taxable, not Social Security or Medicare taxable. So what you find out from that is that your employers are highly motivated to want to participate in these types of plans. I will chat with you in a future conversation um, about the fact that there are some people have some fears around HSAs, and I think they're not well founded, or they don't have a good foundation. And we'll talk a little bit about that because I have not only family members and friends and clients, who when I first heard of this, was like, oh, I don't know, it sounds scary. So we'll talk about why an HSA shouldn't be scary in a future conversation, but wanted to share that with you. All right. Thank you for joining, and we'll have more to come.